Millions of dollars are pouring into platforms like Kalshi and Polymarket every single day. People are rushing to trade on the outcomes of everything from the next election to tomorrow's weather. The platforms promise a crowdsourced truth, an efficient market of ideas. But the reality is that most participants are just reacting to headlines and trading on gut feelings. When you operate that way, you are simply playing a casino game. This chart shows the core dilemma you face. If you want to actually find genuine mispriced contracts, you have to separate the statistical signal from the noise. Doing that manually requires 40 hours a week and your own custom data models. If you stay on the gambling path, treating these platforms like a hobby, you will consistently lose money over time. We are going to focus entirely on this path, building an information and trading edge. To bypass the need for a data science degree, you can use aggregation tools. We are evaluating Picks by Odds, a free platform built to solve this exact visibility problem. By tracking 293 live markets across Kalshi and Polymarket simultaneously, it strips away the political headlines and isolates the mathematical anomalies. Seeing the aggregated data is only step one. Profiting from it requires you to identify exactly which trading strategy matches your bankroll and your tolerance for technical friction. The most obvious place to start is the macro strategy, which focuses on massive, highly liquid markets like geopolitics and major sports. You will see millions of dollars flowing into singular, highly public events like predicting the winner of the 2028 U.S. presidential election. Specific political figures attract huge capital. Right now, there is nearly $10 million actively trading on Marco Rubio's future presidential chances alone. You see the exact same scale in sports. Contracts predicting the 2026 Formula One drivers' champion, like Alexander Albon, carry nearly $10 million. From an operational standpoint, this massive scale offers a distinct advantage. Extreme liquidity means you can enter and exit very large positions instantly, without accidentally shifting the market price yourself. But that liquidity comes with a severe trade-off. Because these events are intensely public and heavily debated, the crowd prices the outcomes almost perfectly. This right here is market efficiency in action. When millions of dollars and thousands of opinions are already baked into a single contract, discovering a hidden mathematical advantage is virtually impossible. If you deploy capital here, you are not exploiting a calculated gap. You are making a speculative bet alongside everyone else. If you want a genuine mathematical advantage, you have to look at the model discrepancy strategy. This requires trading in quiet, niche markets where human sentiment can be tested against hard scientific data. The clearest example of this is weather forecasting. We can directly compare the trading crowd's sentiment against the rigorous models published by the NOAA. This chart shows a glaring anomaly captured by the aggregator. For a contract predicting the New York City high temperature will hit 69 to 70 degrees, the NOAA forecast gives an 81% probability. The Kalshi market prices it at just 8 cents. That is a massive gap of 32 percentage points. This divergence happens because prediction market participants lack meteorological training. They systematically underweight the scientific consensus in favor of their own biases. This strategy identifies mathematically verifiable mispricings. It points directly to moments where the crowd is demonstrably wrong. There are two distinct trade-offs here. First, these niche weather markets have very thin liquidity, making it difficult to deploy large amounts of capital. Second, even the best scientific models have bad days. You can hold the mathematical edge and still lose the trade. Extreme statistical edges absolutely exist, but capturing them requires you to step away from the massive F1 markets and deal with the high volatility of low-volume temperature bands. The third option is cross-venue arbitrage. This strategy ignores real-world outcomes entirely and focuses exclusively on pricing discrepancies between the platforms themselves. This schematic shows the core mechanism, scanning for the exact same event playing out simultaneously on both Kalshi and Polymarket, and catching them when they price that event differently. Right now, the data shows a 98-cent spread on a May 2026 Bitcoin price contract between the two venues. One is trading at a penny, the other at 99 cents. If you execute this trade correctly, you secure a mathematically guaranteed, risk-free profit. It completely detaches you from what the actual price of Bitcoin does in 2026. The catch is extreme operational friction. To pull this off, you must maintain heavily funded accounts on both platforms simultaneously. You also have to navigate complex U.S. regulatory restrictions regarding access to Polymarket. Beyond capital, you face severe execution friction. You have to place your buy and sell orders on both platforms instantly, beating out automated trading bots designed to close these exact gaps. Cross-venue arbitrage provides the cleanest mathematical win, but it is not a predictive trading strategy. It is a logistics and speed challenge suited only for highly disciplined operators. The data gives us one core truth. Despite the intense hype, these prediction markets are not perfectly efficient. Anomalies like that 32-point gap in the New York City weather forecast prove that the crowd can be outsmarted if you are equipped with the right analytical tools. This chart shows how to map your intent against these strategies to determine if you should actually attempt to exploit these edges. If you fall into the bottom left quadrant as a casual speculator, you should probably avoid this entirely. If you just want to put $20 on the 2028 election for entertainment, utilizing an aggregator's advanced arbitrage trackers and NOAA modeling will just cause you unnecessary decision paralysis. But look at the top right quadrant. This is the space for the serious information trader and the data junkie. These tools are built exactly for those willing to embrace the friction of managing dual accounts. They reward traders who ignore the noisy political markets and focus instead on the quiet, mathematically sound weather and crypto spreads. Finding a true edge in a crowdsourced market is rarely about following the loudest conversations. Instead, it comes down to doing the quiet, disciplined math exactly where no one else is actively looking.